So what do we do in this situation? Well, let's continue to look at the risk, and then let's come up with a creative idea that is pre-planned, of course, after we take a look at some more risk. So our general retailer looks like they're going to expire in the second year. Their expiration represents 16.8% of the total gross leasable area inside the property. So that's something to look at. In a couple of years, what does this space look like? Is this space functionally obsolescent? Is this space in a hot area? Is it, is this property a hot area, or is it not in a hot area? Who would come fill that space back in? It's really important to understand, what that picture is going to look like, and work with your leasing professionals to help paint that picture for you. And looks like in year 4, we're going to have 31.7%. So as you get out, more than a few years, it's hard to predict what leasing trends are going to do. So you make your best guess, but as you analyze expirations that are a little further out in the horizon, the way I look at that is, maybe we should, let's say, for example, let's say we had 50% expiring here in year 5. Well, if we had half of our rent roll expiring, it's not the best time to get refinance, right? Because what if some people leave? And the last thing we want to do, especially if we really like this property, is have problems refinancing. So if we had a big expiration here in year 5, I'd really take a deep look at what would a 7 or a 10-year loan look like on this property, because you don't want a big portion of turnover, right before you need to refinance. All right. So what are we going to do? This deal doesn't really meet our criteria. Well, one option is we can bring on some partners. So what I've done is I've put together the partnership model for you to take a look at. All right. And really the purpose of this model, you can do this in many different ways, but if you want to build a waterfall, you can actually skew how it's not a 1-to-1 ratio of, hey, I put in 50% of the money and I get 50% of, profit. You can certainly do that. And if you're going to, team up with some people that, some friends, and maybe everybody throws in a third, and a third, maybe that's what you want to do. But kind of changing the thought process a little bit, if you had a property that had some value add component to it and you wanted to, pursue a value add, you could set up like a GPLP deal. So in this case, we've set up 3 equity partners. Okay. Here's our general partner. The general partner is going to put in $250,000. Okay. That's their whip out cash. That's what they're going to pull out of their back pocket, and they're going to drop it on the closing table. Not really, but that's how much money they're putting in the deal. Okay. Here's our limited partner, number 1. Limited partner number 1 is putting in $625,000. All right. Limited partner number 2 is putting in $625,000. So they have the same equity investment into the deal. All right. So all of that is going to fund $1.5 million, because we said we are going to get a loan for the remainder to make up our purchase price. Okay, so we're getting capital stack looks like $1.5 million in equity, and our debt is going to be $2,679,252.00. All right, let's go back to the partners. So we looked at the contributions. Now we're going to look at the distributions. So what happens when this deal makes money? You're going to see these preference levels. What this means is if you have a preference level of 1, that category gets paid before the preference level of 2. If there's no money to disperse for the preference level of 2, then without satisfying all of level 1, then level 2 does not get paid out, and so forth and so on. So, you know, when we were going through the investment, the distributions to general partner is going to be 20% of the cash remaining. So the cash that could be paid out, he's going to get 20%. Okay, that's how we structured this deal. And it's going to begin whenever our close date is. Okay, and it's going to go throughout the entire investment. Now, limited partner number 1, they're going to get 30% of the cash remaining. Okay, limited partner number 2 is going to get 30% of the cash remaining. For all of you that are really good at math, you can see here that 30 plus 30 plus 20, that's 80%. Where's the other 20? Aha. So I'm keeping the other 20 in the deal. So I was running a partnership model for a different client. And so what I learned is kind of interesting. By keeping some of the cash flow distribution in the deal, you know, depending on what you're doing with that capital, say you need to have capital to, you know, to pay tenant improvements and leasing commissions. It's kind of like it kind of works like a capital accumulation, right? So you get the money back, but you reinvest it in the deal. And so you get a higher return by using modified internal rate of return or capital accumulation by keeping the money in the deal. So that's why strategically I didn't pencil out 100% distribution. All right. Plus, it's good to have a little bit of extra cash, working capital, in my opinion. All right, so we're done with this deal. Now we're ready to sell. So who gets what? In our resale distribution, the general partner is getting 31% of the cash remaining, a preference level of 3. So everybody has the same preference level here in this model. Of course, all of this could be changed. Partner number 1 is getting 33% back. Partner number 2 is getting 33% back. And so 33 plus 33 is 66. Plus 31 is, sorry about that, went the other direction. That needs to be 34. Sorry, that was an easy mistake. But I'm not going to re-record everything. So thanks for working with me. All right. So now that we've decided who pays what, what your equity investment into the deal is, and how the structure is established to get the money out of the deal, let's see how the partners perform. So remember, general partner put in $250,000. It's about 15% of the equity. Okay. And wait a minute, we said we wanted 15% IRR. Now on the deal level, it doesn't make sense. But if we were able to create this partnership agreement, right, it does make sense. So we've got a 27% IRR, okay, to the general partner. And this shows, here's our equity investment, year 1, cash distributed, year 1, you know, and here's the annual return, cumulative return, and so forth, so on. Let's see what limited partner 1 did. Now, limited partner 1 and 2 put up the lion's share of the equity. I believe it penciled out to be around 40% of the equity. So they put in tons of money. The deal level is, what do we say, like 13% IRR. Limited partner 1 is getting 10% IRR. Limited partner 2 is getting 10% IRR. I'm not saying it's a bad thing for these guys. You know, maybe in this situation, the general partner, maybe they've guaranteed the loan. Maybe they have the experience to lease out the space, or maybe they have the the experience to develop something. So the limited partner role is very passive, okay? And so maybe 10% is great because the other option for them is to go invest in T-bills or roll their dice in the stock market. So I'm not saying it's a bad thing, but I did want to show you how it changes, how the investment is skewed from an equity investment, the deal level internal rate of return, and the investor level internal rate of return. All right. So I hope I haven't bored you to death. If any of this is exciting and you want to do some investing in commercial real estate, I'd love to work with you. I've got a lot of experience. I've done property management, contracting, entitlement, leasing, investment sales, many years of that. I was president of our CCIM chapter, 2015, 2016. The committee chair for the CCIM Institute for networking. So I hope you've enjoyed this video and have a great day.